Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different. But it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, then that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.